Hey, welcome to the podcast, everybody. Thanks for joining me. Appreciate it. It's getting out a little later than I would like. Had some things to get to, but wanted to give you a rundown on what's going on the last few days. As you can see, the market's green, not real bright green, but the Nasdaq up 0.5%. Had the Dow Jones up 25 points. Transports continuing to outperform the last 3 days. Russell 2000 continuing to outperform the last 3 or 4 days. S&P was up just fractionally. And interest rates were finally down today, which we'll get into in just a minute. So overall, you can see, again, the bulls having their way right now. All right, let's start off with the S&P 500. And as you can see, the little channel it was in, it's kind of broken out of that a little bit to the upside. But now, obviously, the big question is the old dreaded double top, triple top, whatever you'd like to call it. And there's no question that if you look at the top back in March and April, and then you look at the top now, and I say top, again, not knowing the future, but let's just assume it's a top right now. But if you look at those two reference points at about 1420 or so, the internals of the market are continuing to be very weak, not getting stronger. They're not confirming this rally. So, again, you have two choices to make. Do you just acquiesce and say, yes, I'm just going to join in to the party, and then potentially get burned at some point and lose a lot of money on the downside, which is what happened to people in February and March. And perhaps when they did get burned, they started to sell out down here and they never got back in. Do you do that? Or do you say, I'm going to not do anything and just, sit in cash? I don't think that's the right move either. I think what you do is you buy some positions that you feel comfortable with, that potentially could go down. Maybe they're going to go down a little less than the market because of their lower beta, or you simply defer some of those new purchases. But I think what you absolutely don't do is come in here and buy, an S&P 500 fund, a Spiders or something right here when it's an obvious place that, we could see the market roll over. Even if it's a temporary rollover, it still is a place that a lot of people are watching, and you'll probably see some selling come in. The only reason I hesitate in telling you this is because it is such an obvious place that, we could see the market actually broke through, and I talked about this on the podcast earlier in the week, break through, and everybody says, oh, this thing's really going to take off. And then it's what I call a fake out breakout, and it comes down, and we come back down into this, and perhaps maybe we touch down to this 200-day moving average or something like that. I could see that happening, so don't get caught up in right when it breaks out to jump on board and think you're going to miss the train. I think, again, whether you want to be averaging in, that's fine, but I would not get over leveraged here into the market because, again, the internals simply are not confirming what's going on. And that's hard when it's doing that and going up what feels like every day. As you can see here, the volume has been very weak. If we zoom in the last 3 months, the volume continued to get worse and worse. It's going down. But again, more so than that, it's the quality of the volume. You're seeing less and less stocks participate as this rally goes on, and that's a big problem. That's a big characteristic of a stock market rolling over is when a stock market goes up, and yet you look at who's tagging along on this little journey, and you start to look over your shoulder, and there's less and less people following you. Pretty soon, the party's over, and I think that's really what's happening right now, but it happens in slow motion. And I mentioned this before. It happened in 2007. It happens a lot where you see markets will just kind of grind a little bit higher, and then eventually they roll over, and sometimes the volatility picks up dramatically. Now, I wouldn't be saying this just because the volatility index is low. A lot of people look at that and go, hey, it was down another 6% today. Looks like a new low. Boy, the market has to go up because when the VIX is low, look out below. That's the mantra on Wall Street. Not necessarily. And I'm not even going to show you all the times, but in a healthy bull market, what happens is the VIX is low and basically showing people have confidence, and the market keeps running up. So it's not just a contrarian indicator. If you treat it like that, you're not going to make money either trading the VIX or the stock market. You have to look at the whole package. Yes, we know that it's low, so there's no fear right now, and there's extra complacency. So yes, that gets our attention. But there's other factors to consider besides just the VIX. Because if that was the case, again, you would have been selling stocks here, and now here. So, watch for that. You may want to say, hey, when the moving averages turn or something. I look at the how fast the VIX is moving up or down. That really tells me a lot. And right now it's best a methodical fall. And again, it's something to watch, but it's not something to make me run out and sell stocks tomorrow. Sometimes I hate to tell you things that you probably already know, but I'm going to have to say it anyways because it's kind of a big deal what's going on right now. You're seeing a rotation out of the consumer staples, the defensive areas, into the very cyclical types of stocks. Either it is a rotation just because things got too stretched, right? The defensives got too easy of a trade, and so they're selling there and profit taking, and that money's finding a way into the beaten down sectors. Or the economy's getting better. Well, there's a third possibility, which is the economy's not getting better. It's simply a trade where people are hopeful the economy's getting better, and they're betting on that. And guess what? If the economy continues to get weaker and they become surprised to the downside, then these things are going to fall rather dramatically. But you can see XLY just in the last couple of weeks here, you've seen a real run-up, and an acceleration to that run-up. And then when you look at things like, XLP, kind of flatlining. If you look at XLU, some of the utilities, those are going down right now. In fact, one of the things, and this is just a microcosm in the last couple of days here, but if you look at just some of the Dow components today, the top of the list, United Technologies breaking out. Caterpillar, again, had been beaten down. We talked about that the other night severely, so could just be bouncing, but it's been going up. The Home Depots, 3Ms, Microsoft, some of these cyclical things leading the way today. What were the losers in the Dow today? Johnson & Johnson, that looks like a rollover. Pfizer, weaker. Merck, clearly a rollover there. Again, in the short term. Kraft Foods, weaker. So this rotation has been real this past couple of weeks. If you look at small caps, again, strength in the last few days. Then, of course, we look at interest rates. Interest rates came down, and they had bounced back up now to their 200-day moving average. So today you saw them come back down. But this has been a pretty big move from 1.4% all the way up over 1.8%. We're starting at a much lower level. But this is a bigger move than we saw back in March. And remember, that move back in March over here was a time frame where we saw a lot of things sell off pretty quickly as far as things that were fixed income based. What you're not seeing now is you're not seeing a whole selling across the board in bonds. It's really specifically in treasuries. Other types of bonds are still doing just fine. So people are coming out of the safer credit and going into some of the riskier credit. So, again, all these things point to a stock market that, again, in the short run here, has been improving from a price standpoint and looking at everything from the helicopter view. Okay, where's money shifting out of? Let's follow the money. It's shifting out of the staples and treasuries and the safe trades, risk off, and it's going into risk on, and it's again, the cyclical type names, the Home Depots, the home builders, the Caterpillars of the world, steel companies. Those are doing well right now. But there's no evidence to support that. Now, I know what you're probably thinking. Well, Karl, don't stocks sometimes lead the news? They do, and we need to respect that. But what I would like to see, if that was the case, was I would like to see the volume be ramping up on these, as we're going to newer highs here. The volume should be twice what it is, 3 times what it is, and it's not. And then again, the quality of that volume is just not confirming this. So, as I've been saying, proceed, but proceed with caution. Again, there's plenty of things to buy, income production and so forth. But one thing I would caution you is things that are very interest rate sensitive, start to watch them. I sold AG&C yesterday, which I'd owned for a while. This is a very, it's a REIT, mortgage REIT, and it has a 15% yield. And I sold it. They had issued some new stock here, and the stock bounced back, and that's very common for these guys to do that. That's the way these businesses work. But after they did that, it bounced back, started to roll over again. I sold it because they have a lot of fixed rate securities in their portfolio, and because of that, they're going to be more sensitive to rates going up. So you have to watch that. It could be the same thing with Annaly Mortgage. So you really, when you're buying these types of high-income production securities, you really have to go in there and say, hey, what's their portfolio? What are they holding? That's very important. It's real easy to look at these yields of 13%, 12%, 10% on some of these these REITs and say, I'm just going to buy that. It's like a bond. It's not like a bond. what happens is when rates go up just a little bit, sometimes these things they go down a lot because they're so highly leveraged. So if you think rates are going to continue to push up, then watch that. What you might consider doing is readjusting in some that have more adjustable rate mortgages if you're in that area, floating rate bonds, things like that. So it's not to say you can't still be in these, but you may have to shift around to find some different ones that don't have those same components, and they're out there. So be careful if you have a lot of interest rate sensitive type securities. Let's jump to Apple real quick. This is one of my holdings. I've held it for a long time, sold it during some of this congestion area, and recently got back into it, I don't know, maybe 2-3 months ago. I think right when it was starting to break out here. So it's had a nice move even since that purchase, but it's breaking out to new highs right now. And obviously there's a lot of anticipation now because they have the iPhone 5 coming out. And on top of that, there's an iPad mini in the works, which if you check the channel checks and go down the line to some of the people that supply Apple, there's no doubt that there's an Apple iPad mini on the way. And all they're doing is trying to compete at a different price level. You know, an iPad's not a cheap device, $400, $500, $600, $700 depending on which model you get. This is going to probably be in the $299 range, maybe even the $199 range. It's just going to be a smaller iPad. It's going to be somewhere between an iPad and an iPhone, and I think it's going to be real popular. So that's going to help them a lot. And then there's rumors now of an Apple TV, which is going to be actually a set-top box embedded in an actual TV screen that essentially looks like a big iPad, and you can touch it and do all kinds of stuff, probably talk to it, tell it what channels you want to watch and what sports you want to watch, and it'll find it. I don't know if that's going to be the most profitable part of their business, but it's going to provide the halo effect that they want. When people buy that TV, that's going to lead them to buy other things at Apple. That's going to lead them to say, you know what, I already have that. I might as well switch computers now. I might as well get an iPhone. Or vice versa, right? They could be buying an iPhone and say, hey, I might as well buy that TV. So that's what it's going to be. It could almost be a loss leader for Apple. Now, there was a lot of debate this week because there's some people that are adamant that this is not going to happen, that they're just simply going to have a set-top box, almost like the Apple TV, which they have right now. And others say, no, this TV is definitely coming. Some way they're gonna be a little more visible in your house as far as television's concerned, one way or another, whether it's a real TV or not. But those three things are what's driving the stock up right now, and the fact that, the stock moves sideways. You go back and you look at Apple since 2008, it has run up, moved sideways. Here's a move, up, sideways, up, sideways, up, sideways, up, sideways. So I just think we're starting the next move up. And I think there's no doubt eventually it'll get to $1,000 a share, whether they split it or not, who knows. But the bottom line is it went under the radar. It was very, very quiet as it's been moving sideways and nobody was talking about it, and here it starts creeping up, and all of a sudden it goes to a new high. So another impressive move. Again, a company that's growing their free cash flow. It's not expensive. It's just a cult stock that you kind of have to stay with, and it's working. I'm glad to be a shareholder. Now let's talk about the latest edition of the flash crash because it's happening a lot, and it's not getting a lot of publicity, but this happens much more frequently than it used to, and obviously a lot of times it's been happening since May 10th, 2010, or excuse me, May 6th, I think it was, 2010. Yeah, May 6th. And that was the day the Dow Jones, of course, fell 1,000 points in under 30 minutes, finished down about 300 on the day. Really hasn't been explained. Some people believe it's a high-frequency trading, which is supposed to add liquidity, but sometimes adds volatility there. And a lot of stocks have what happened to Dollar Tree yesterday has happened to them. And what happened to Dollar Tree was they came out with earnings, and they actually beat earnings estimates. Revenue was basically in line. Had some cautious things to say going forward, but had received several upgrades today. But the bottom line was the stock was around $50 a share, and in the first minute it traded all the way down, as you can see, and at the low it was at $38.40. So it went down to $38.40 from $12. That was a 24% drop, and literally just in a few seconds it ran back up, and then the rest of the day was kind of flat and ended up finishing almost even on the day, I think down 1% or something. So, you step back and say, well, what happened here? I don't know what happened. We don't know what happened during the flash crash. But the bottom line is that this is another reason why I would encourage you to use price alerts, not price stops. And I know some of you, a lot of you, obviously don't manage your own money, but you may have a job, and so you can't watch it all the time. But there's plenty of systems that will alert you when a price hits a certain level. By those people who said, I'm going to put a stop at $50 a share, this nice round number, the earnings come out, and there's all these sell orders get smacked onto the opening, and the stock plummets, and then the supply dries up instantly, and the stock goes back up. They didn't cancel these orders. Somebody got filled down at these levels. It's the same thing, right in here. Somebody got filled. It's the same thing that happened with Procter & Gamble back during the flash crash. Procter & Gamble was a stock that was, I think, $60. During the flash crash, it went to 40, 38 or 40, and people got filled down there. So remember, what a stop loss is it says, I'm going to accept the next market order when it goes beneath the price that I'm telling you. So if it goes below 50, get me out at whatever price. That's what you're saying, whether you know it or not. And so people that got filled at 38.50, that was the next price. So what I would rather see it do is email you and say, hey, this stock went below, and then you can make a decision whether you want to sell it or not. And, I have to do that regardless, and obviously I have a little more sophisticated systems on Bloomberg and so forth that alert me when stocks do certain things if I'm not watching them at that minute, as opposed to just emailing me or something. But the point is that I have to do that because of the number of shares that I'm buying. I can't just put a stop loss in, owning 40,000 shares of a stock. It would move the market regardless. But that's kind of what happened with Dollar Tree here. And you need to be very careful when you're using stop losses. Generally, stops work okay if they get triggered in during the day and it's on a McDonald's or something. But look, this stock trades, a lot of shares during the day. It's not an illiquid stock. But for whatever reason, this happened yesterday. And again, you got to be very, very careful when you're using stop losses. So another example of a flash crash, which kind of went under the radar, but it's basically a miniature flash crash from what happened to the whole market back 2.5, 3 years ago. Okay, guys and gals, that'll wrap it up for this time. Remember, stock market is at this potential double top. Looks a little obvious, but again, the underpinnings of the market are not really supporting it. So I've kind of got one leg in the water, one leg out, and one hand on the sell button on some items. But again, there are trades to be made, no doubt about that, and I would not ignore this move and the cyclical nature of it as far as what's happening with the transformation coming out of the defensives into the cyclicals. But I hope you guys have a great weekend. Don't forget eggerscapital.com, twitter.com/Karl Eggerss, Google+, we're on there, Facebook. Hey, and also for those that still use iTunes and watch podcasts through iTunes, I am on iTunes as well, so you can subscribe through iTunes and get the podcast sent to your iPhone that way as well, or iPad. And the Apple TV is a great way to watch the podcast as well. So have a great weekend, and we'll talk to you soon.